Hello friends, welcome to my YouTube channel at One Raj Kamal. As you go through this video, please do subscribe and press the bell icon so that you can get readily intimated whenever a new video is put in. The last week was tough for the markets and they continued the decline of the last 2 weeks. Dow Jones was down 2.99%, S&P 500 was down 3.29% and NASDAQ was down 4.2% as you can see this chart. In fact, there are a lot of technicals at play in the market, and I'll show you some charts. See this one, which is S&P 500, and you can see that it has pulled back from the 200-day moving average around mid-August and is currently testing support at 3,900, which was also the low of May this year and the highs of June and July. Similar technicals in NASDAQ on this chart, where you can see that there was a pullback again from the 200-day moving average. And now it is testing 11,600, which was the high of June and July. If you go to individual stocks, again, similar behavior. Let's look at Apple on this chart. And you can see that Apple pulled back from near triple highs and is now testing the 50-day moving average. The only stocks which are not in this pattern are those where there are company-specific news. For example, Nvidia is at an all-time low on the news that the US government has placed new restrictions on the sale of sophisticated chips like the ones sold by Nvidia to China and Russia. So only in cases where there are company-specific news, one sees technicals not so much at play. Where do markets trend from here will actually depend on whether each of these supports hold. So whether the supports on S&P 500 and NASDAQ hold, or the 50-day moving average support in Apple and other such stocks hold. Normally, everybody in the last few months has been talking about what's going on in the US markets. And yes, it is the biggest market in the world and probably the most influential. But it's also useful to talk about other markets and in particular emerging markets. And I want to analyze some emerging markets in today's video. Emerging markets, as you can see on this chart, are actually down big time since the start of this year and haven't yet shown any kind of bottoming. Unlike the US indices, where we've seen a kind of a bottoming in June this year, after which the markets have shown either support or have begun to rally back. This is probably driven by the fact that the US dollar continues to be very strong and in fact seems to be strengthening, and a strong US dollar is a headwind to emerging markets. If you look at emerging markets over a longer period, since 2000, as you can see on this chart, the picture also is not very flattering. While there was a precipitous growth from 2003 to 2007, when terms such as BRICS were in vogue, the reality is that the trend since 2008 is barely positive. However, averages hide the story of dispersions. And while averages for all of these emerging markets don't look great, some markets have actually done better. And India is actually one of those markets. See this chart for all the major indices of the world for 2022. And you can see that while London's FTSE has been the best performing index, BSE Sensex, which represents India, has been the next best and broadly flattish for 2022 compared to S&P 500, which is down over 15%. In fact, all other major indices, be it DAX, Nikkei, Hang Seng, Shanghai or CSE, are all down. That's 2022. Let's look at a longer term picture. So here is a chart since 2000 on the same indices, and BSE Sensex has actually been the best performing index with returns of 978% since the start of 2000. Compare this with S&P 500, which has gained 177%, Shanghai 130.4%, and Nikkei 46.7%. The other major indices, DAX, CSE, Hang Seng, and FTSE, have barely moved. And this trend of BSE Sensex actually outperforming has been true since the 2008 crisis as well. So see this chart of all the major indices performing since 2009. And you can see that BSE Sensex at 610% is the best performing one. Compare this to S&P 500, which is up 495%, Nikkei up 293%, CSE up 147%, DAX up 127%, and FTSE up 110%. In fact, the worst performing are the Chinese indices, probably driven by the geopolitical tensions that have been frothing between US and China for the last 3 to 4 years. In fact, on a relative basis, Nifty 50, which is another measure of the performance of the Indian market, is hitting all-time highs versus Dow 30, as you can see on this chart, and is likely to break higher into the stratosphere. Why am I showing these charts? Well, for two reasons. First of all, I think that we've seen the lows of the current cycle in June this year. And the reasons I've mentioned in my previous videos. Second, markets are an aggregation of individual stocks. And even in the worst of times, as probably this market is, there are pockets of good performance. Some of these that have withstood the test of time actually make a big leg up when the tide turns. Thank you.